Welcome to Invest, Build, and Prosper with Zach Matson, the podcast where we dive deep into the world of real estate, land investment, and development. I'm your host, Zach Matson, and every week we'll break down the strategies, tips, and tools you need to turn your real estate goals into reality. Whether you're just starting out or a seasoned investor, this is your go-to source for analyzing deals, uncovering opportunities, and learning how to build wealth through land and development. From understanding market trends to navigating legalities to maximizing returns, we cover it all with insights from experts and real-world examples you can use right now. Ready to invest, build, and prosper? Let's get started. Good afternoon, investors. Welcome to our very first episode of Invest, Build, and Prosper with Zach Matson. Today we are going to pull back the curtain of infill development and teach you how to unlock massive wealth. Let's first start off with the different ways you can approach making money with infill subdivision. Probably the easiest way to gain a chunk of money in infill is simply just splitting off a lot from an existing property and selling it to a builder like me. Whether you own the piece of property already or you go out in search of a property with a potential lot split, this is an easy way to earn six figures within a year, typically on just one deal. To go along with that idea, you could also split a lot and build something, whether that is another single family home or a duplex to keep as a rental, or either of those to sell for a larger chunk of money. I will say with this scenario, typically if you're going to hire a builder to build something to sell, the extra money you'll make in this scenario and the extra time it will take to make it typically isn't as great a return on investment as just splitting the lot and selling it to the builder. But you can certainly get creative, and partnerships can be a powerful tool. Another way to gain wealth and potentially adding cash flow to existing property is simply building an ADU or an accessory dwelling unit, also known as a granny flat, mother-in-law quarters. This is typically a small home that's typically has its own entrance and is mostly separate from the primary home. This could be in the form of a basement living unit in addition to an existing home, or living quarters above a garage, or even a completely separate small home in the backyard of the existing property. Typically what you will spend hiring someone to build this doesn't add to your wealth, and in some cases you'll spend more than the value it's adding, but this is a great long-term play and can still potentially add cash flow as a rental depending on how you approach it. Converting an unfinished or unused basement into an additional unit can also be a value add strategy, whether that is an ADU or to convert the existing home to a duplex. There's typically more involved with converting it to a duplex, but could increase the value significantly. A little more involved process of infill development is subdividing. Subdividing is a process of taking a larger piece of land and subdividing it into multiple parcels. Some municipalities have an easier process for doing these for a small number of parcels, like 4, for example, and a more involved process for a larger subdivision. This process typically takes a little longer than the above, but it creates wealth at scale all at once. With any of these previous methods, you can either sell off the land or entitled project, or hire a partner with a builder like me to build units to rent or sell. Infill is how I personally started thriving in real estate, and it's one of the best opportunities out there today for anyone looking to build wealth. Infill is great because it's a much lower bar to start in it than pretty much any other development out there. The regular homeowner can split a lot off of a house that they already own. You can go in and buy a house that is sitting on an acre and add 7 more houses to it. There's a lot of opportunities, and as long as you are committed to learning how to do it and then just committing to taking action, a lot of times it can be super valuable to your wealth building journey. So how do you get started? The first thing you want to do is pick a location that you intend to invest in. Each city, even within a metropolitan area, can have vastly different zoning codes. So the best way to start is to pick a town and get set up on a search. A realtor can help you determine what size of land you should be looking for to do what you want to do based on the local zoning codes. If you're in the Treasure Valley area in Idaho, my team can help you with that. Either way, it's important to be connected to a realtor that really understands land. The next thing you want to do is get a base level of knowledge of the zoning districts. Each town has typically dozens of different zoning codes or districts that can be a mix of letters and numbers, R1C for example. Even though there are dozens of codes, most of the time you're primarily only going to be operating in 3 to 4 of those zoning districts. So it's important to know which districts are the primary ones you'll be navigating. A huge tool when it comes to looking at potential land deals is the local planning and zoning office. They're typically eager to answer questions and can be a huge help in clearing up any confusion on what you can do. Based on what they tell you, you can typically sketch up a rough site plan, and then it's a good idea to go back to the city in person or over a Zoom call to review that potential site plan with a planner. This is just a base level due diligence that you can do even before you have a property under contract to gain a lot of knowledge. Now that you're set up on a search with a qualified realtor, you can start analyzing some potential deals that they're sending to you. A super basic calculation I use for the potential of a property is taking the size of the land multiplied by the number of units per acre the zoning district allows. So for example, in Boise on R1C, a common zoning district allows for 12.4 units an acre. If I found a 0.25 acre piece of land, if I multiply that by 12.4 units per acre, that gives me 3.1. So I can potentially get a total of 3 units on that quarter of an acre. Now that is just the starting point, as now you have to further analyze the deal to find out if you can maximize the density as well as if it's financially a good deal. For starters, to stay in the very, very safe zone of someone looking at a land deal, I would recommend looking at properties that the existing home would be the same value whether you split off the land or not. This will keep your cost basis on the extra lot at zero, at least until you start paying for services to split the lot. But this is a very much safer place starting out than buying vacant land and not knowing exactly what you can do with it, or paying an amount over and above the house value just because there's a potential lot split. Once you've determined the maximum number of units you can fit on the land, the next step is to put together a site plan or hire a professional to do so to fit the maximum number of units, or to otherwise use the land in the best way possible. This is also referred to as highest and best use. This process is part art and part science. When determining the highest and best use, you want to consider what is appropriate for the neighborhood as well as follow all the rules and regulations of the zoning code, which can be a little tricky. For example, even though the zoning code may allow for a 4-story apartment complex in a neighborhood, if it's going to be right in the middle of 1-level homes, it's probably not a good fit for the neighborhood. Starting with the end in mind is key in analyzing the feasibility of the project. Once you've determined the type of product that would be best in the neighborhood, you can then move forward with how many total units you can add. What will those units sell for? If you're just going to split the lots off and sell them, this is still important to know because having an end marketing plan to sell the lots is also key. If your end goal is to split the lots and sell them, what will those lots sell for? It's important to have accurate comparables, which your realtor can provide you. Make sure you're analyzing on the conservative side and factoring in differences with comparables, such as if one is on a busy street, the surrounding neighborhood, what that looks like, etc. You'll then want to work backwards from there. What will the lot sell for? What are the selling expenses? How long will the lot split take? And are there any monthly expenses for holding the project in the meantime? If you're borrowing money, how much does that money cost? Soft costs are costs that you incur, but no physical work is being done on the lot. You want to get an accurate estimate of your soft costs, survey fees, government fees, engineering, etc. And what are the hard costs, if any? On some lot splits or subdivisions, you're required to put in the site improvements before you have a legal parcel to sell. Hard costs include utilities, roads, sidewalks, fire hydrants, streetlights. What are your carry costs? Interest payments, utility fees, taxes, insurance, site maintenance, etc. And the final expense, which is actually the first expense incurred, is the purchase price, which is ultimately what decides if the deal is profitable or not. You'll hear a lot of investors say that your profit is made on the purchase, and that's no different in land and development as it is on a single-family home or an apartment complex. In a future episode, I will do a live breakdown of a potential deal to show you how exactly I analyze deals. After taking all your expenses into consideration, what's your net profit after all these expenses? What's your cost to value percentage? What's your profit margin? All of these are good to know, especially if you're going to try to leverage the deal to use somebody else's money. Investors or lenders want to know that their money is secure as much as possible. It's also important to be able to provide a good return on their money. Another thing to consider is what the trajectory of the market is. The past couple of years in Boise, for example, the market was on a downward trend. As a result, it wasn't smart to analyze a deal without accounting for a loss in value at the tail end versus the prices of the comparables recently. If it's on an upward trajectory, it's best to just use that as a bonus, but don't account for that in your numbers. Nobody has a crystal ball, and accounting for market increases over time is a good way to lose money. You want to be sure when you're analyzing your deal that the deal can handle some market turbulence and still be profitable. How long is your deal going to take? Ask people who have done what you're trying to do, and they'll tell you how long it'll take. What is looming on the horizon of the market that may cause a shift in values? How accurate are your soft and hard cost estimates, and have you built in a contingency? No matter how good your estimates are, you almost always will go over budget. Time is money in real estate, so the quicker you can get your deal done, the more profitable you will be in general. Even if the market is on an upward trend, the quicker you can get it done and move on to the next deal is huge in being able to maximize your return. To keep the project humming along, you sometimes need to grease the wheel. Phone calls go a long way, especially with planning and zoning departments. Many times you'll call and find they'll be able to push something along that's been sitting in the ether for weeks. The key is to set a schedule and then keep following up with everyone involved to keep it on track. Consider hiring somebody with experience doing this, but also keep in mind that a project manager may have 20 other projects they're working on, so sometimes they need to be kept on track as well. Always remember that time can make or break a deal, and it always takes longer than you think it will or should. How do you get to a place where you feel good about a deal? First off, decide that you're going to analyze 1 or 2 deals a day, 5 days a week, or 10 deals all in one day. You can analyze these with basic numbers to start before committing to a deal and going into further detail. If, for example, you're just going to look at potential deals where you can split off a single lot, get a rough estimate of what these costs will be to do so. Then go through the other costs described previously. If you think you found a good deal, you can further analyze it by looking at it with multiple exit strategies. One of the reasons why I love land is because there are so many different ways to exit, and typically you are adding value at every step of the way. For example, you can first analyze it with the intent to sell off the lot on the MLS with a realtor, or consider doing an owner carry with a percentage down and monthly payments or accrued interest at the end after the end product is built. Also take a look at hiring a developer to take it through development or a builder to take it through the finished product. Analyze keeping one or all the units as rentals or to sell. The next key is committing to taking action. Make the decision up front that by the time you analyze 100 deals or sooner, you're going to then commit to making an offer on one. It still has to be the right deal, and you may still need to analyze 100 more deals, but make the commitment that you're going to make an offer. If you want to have a 3-month timeline, then analyze 10 deals a week. If you want to turn that into a 1-month timeline, analyze 30 deals a week. Once it's time to make an offer, there are some things you should consider including with land that are not typical with buying a traditional single-family home. Your due diligence period, for example. There's typically a lot more diligence involved than a regular single-family home. You want to have a minimum due diligence period of 30 days, but ideally 60 or more, especially the more complicated the deal is. In a perfect world, you could get some sort of project approval from planning and zoning before your due diligence period is up. A staggered approach to due diligence is also an option. Earnest money released to the seller in phases in exchange for longer due diligence periods is sometimes a great way to negotiate diligence periods until having project approval. The other thing this does is buys time to keep costs lower of owning the property. If you can get an approved lot split before closing on the property, you can then split the lot and be out of the deal within just a couple of months potentially. During your learning period, but then especially during due diligence, figure out how you're going to fund the deal. Land has a higher bar and less competition because it's harder to fund. If the land deal you're looking at has an existing house, it is much easier to get financing. You may qualify for a traditional mortgage or an investment home mortgage. Most land deals are done with cash. Where are you getting the cash? Do you have money saved up? Do you have money in an IRA? Converting an IRA to self-directed is a potential way to control your own investments and see explosive growth. If you don't have your own money, you can use your other people's money. Consider partnering with someone that can bring money to the table. Most people have people in their immediate circle of friends and family that would be interested in investing in a land deal with the right circumstances, knowledge, and partner. Other options are a land loan from a local credit union or bank. They just typically require anywhere from 25 to 50% down. Or similarly, you can get a loan from a hard money lender, but only a small percentage of those fund land. In future episodes, I will dive much deeper into all these other options. Once you have your funding in place and your due diligence done, the next step is to close on the deal. Again, ideally, you have some sort of project approval before closing, or at least a high degree of confidence in what will get approved. Part of this is experience, but part of it is based off the conversations, ideally multiple at this point, that you've had with the planning and zoning department. After all of this, it's time to get to work. If you're local to the Boise area, my team can help all the way from finding and analyzing land all the way through the phase of construction. I also help people passively invest in real estate by either partnering with me, lending to me, or investing in my infill real estate deals. If you have the ability to buy land or property that can be subdivided and can cover the costs all the way through, my team can do everything else. Thanks for listening, and if you enjoyed what you heard, be sure to give me a like and follow on YouTube, Instagram, and all our other platforms, which you can find in the description below. Be sure to tune in to future episodes where we go further in depth on land and investing.